Hey, what's up guys? Welcome back to the channel. In this video, I want to address a very important topic discussed in the market today about Warren Buffett's main indicator, which is telling us that the market could be overvalued significantly even after the current crash. This indicator has caught a lot of people off guard, and it's surprising that nobody was talking about this a year and a half ago when stocks were actually in a bubble and in a massive rally. Instead, now we can see that this indicator is sitting at 150% with a significantly overvalued moniker around it, which is scaring a lot of retail investors into buying stocks during this massive bear market. So in this video, I want to essentially debunk the myths around this indicator, what it actually tells us about the state of stocks in the current market, and whether or not this indicator is supposed to be a good metric to base your buy or sell decisions in the market. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. As you can see from a historical trendline basis over the past 70 years or so, this indicator is clearly telling us that the market is overvalued in air quotes. But again, we need to put this into context. The market, based off this indicator, has been overvalued for a majority of its lifetime over the past 100 years, ever since the stock market was created. And so, in my opinion, that right off the bat tells us that this is not a science, this is more of an art. Meaning, just because this indicator is above its historical trend line doesn't mean you don't want to buy stocks. Because Warren Buffett and Berkshire Hathaway have obviously been buying stocks over the past 70 years. Otherwise, their portfolio would not have returned the massive percentages that it has over the past 70 years. And so essentially, we need to put this into context with GDP and economic growth and the state of the current economy. Now, essentially, how this indicator works is that it divides the aggregate US market value by the GDP of the economy. And so on the surface, this looks like a pretty logical thing to do. But the key thing to keep in mind is that the total US market value, at least over the past decade, has been significantly saturated with software as a service stocks, or as we like to call IT stocks. If we actually have a look at the weighting of the S&P 500, as you can see, 28% of the index is controlled by IT stocks, meaning these are gross margins of over 70%. These are your stocks like Apple, Microsoft, Google, right? Netflix and Amazon as well. These companies have significant gross margins, which means that their productivity levels are significantly higher than industrial companies like Boeing or aircraft companies like Delta Airlines or JetBlue. Right? The companies like in the American Express, Bank of America, those margins are significantly lower than IT. And over the past 10 years specifically, IT has become a bigger component of the S&P 500. And so, in my opinion, that is a reason why this indicator has shown us this overvalued nature for such a long amount of time. It's an important reason why this indicator has gone up more exponentially than it has over the past 20 years. And that's because productivity levels have accelerated. And although GDP is still lower than where the market cap is, GDP is going to catch up to the global market cap faster than it ever has over the past 100 years. Because don't forget, long-run economic growth is what determines the fate of the US economy and the eventual fate of every single stock and business in this country. And long-run economic growth is primarily driven by one thing, which is labor productivity. In the business sector, at least, as you can see, ever since the dot-com bubble and the global recession in 2008, productivity has actually accelerated to the upside. And this is primarily driven by consumer electronics, smartphones, obviously faster processing speeds, and SaaS, or software as a service. And since it is a very high margin thing, it doesn't necessarily immediately get accounted for in the GDP numbers that we look at. And so I think, although Warren Buffett's indicator has clearly shown us a pretty big warning sign that in 2020 and 2021, the market got very overheated, right now, it's not showing us that the market is a bad buying opportunity. It just tells us that the bubble has popped and that now we're coming down to more normalized levels within this global overall uptrend that we're seeing. Because as you can see, through this crash, the indicator was still overvalued by a pretty significant margin. but those were not bad buying opportunities. Actually, you wanted to take advantage of those buying opportunities instead. And as you can see in 2008, we actually saw a significant collapse in this indicator, which right there and then tells you it was one of the best buying opportunities you could have ever seen. Even if you had bought here, if you had averaged down and dollar cost average into your positions, you would have come out well ahead of the rest of the folks that might have panic sold here and actually taken a realized loss. And I think that right there is one of the key things we need to remember as retail investors. And the other thing we want to keep in mind is that although there's a lot of doom and gloom in the stock market right now and people are extremely fearful, overall, we are in a much better position than we were 20 years ago in the dot-com bubble and obviously in the global financial crisis. This right here looks at all the equity bear markets that we've had in the S&P 500. Now, although in 2022, when this specific graphic was made, we were not in an S&P 500 bear market. If you guys have been around in the market, obviously you know that last week we did enter a bear market. And so this puts us on this chart right around this general area, which is when the stock market is down around 30%. And that's specifically for the NASDAQ. Now, the S&P 500 can definitely fall more, and it could put itself way higher on this chart. But let's just keep in mind where the market has been ever since each one of these bear markets. And right off the bat, these kinds of 50% declines are very unnatural to be happening when there is no economic problem in the economy. Right now, the economy is pretty strong. And all we're doing with interest rates is overheating or cooling down the overheated economy that we saw. And you got to keep in mind that the Fed is much more afraid of deflation than they are of inflation. That's why the Fed has a positive 2% target for inflation over the long term, because that is much better than having deflation. And so overall, we need to keep in mind that deflationary periods, like all these events at the very top, are significantly worse for the economy than inflationary periods like we're experiencing today. And so overall, you need to keep this perspective in mind. And even the Warren Buffett indicator itself doesn't tell the whole story about how the economy is going to function. And as you can see, somebody like Ron Barron, who made a massive investment in Tesla a couple of years ago and was really fighting against the trend when it comes to buying the dip on a very controversial position for a long time, himself is saying that right now is a pretty good buying opportunity in the stock market. And even he himself disagrees with the way that the Buffett indicator revolves around the economy and the stock market. One of the things the Buffett indicator really doesn't take into account is the fact that interest rates are significantly lower than we had them back in the dot-com bubble and in the global financial crisis. Now, obviously, interest rates are going up, and that is a bad thing for stocks. But a lot of that is already getting discounted in valuations. As you can see, as the 10-year Treasury yield has gone up from around 1% all the way up to 3.5%, the stock market has equally crashed down to earth. And overall, we are still well below that historical average of 6%. And so still, that puts us in an economic growth phase. Now, yes, if inflation stays at 8% for the next 3 years, then this is going to be a very bad thing for the stock market. But given just how fast inflation went up, there's a very equal likelihood that this inflation situation is also going to come back down just as fast, because this was a pandemic-induced inflation event, not an actual economic problem-induced inflation event like we saw in the 70s, because that's when obviously Nixon took us off the gold standard, and that significantly overvalued or actually devalued the US dollar. Instead, right now, the US dollar is very strong, and because of that, we're just seeing a little bit of higher inflation than we would have expected, which is obviously something that's requiring the Fed to take action. And apart from that short-term stuff, the long term is still very much intact for the market. And as you can see, the other thing that is a big criticism of this indicator is the fact that it doesn't account for bond values and international sales, because GDP just consists of primarily net exports. And as a result, any company that's in the US that's doing business outside of the US is not going to be counted in the GDP number. And obviously, a lot of stocks on the S&P 500 include businesses that are outside of the US. There's a massive market of Amazon and obviously Europe, Africa, and also big parts of Asia. And that is simply not included in the GDP numbers that the Warren Buffett indicator is looking at. And so that could be a pretty big indicator that this specific market value to GDP method is not the best when it comes to analyzing growth models for the stock market. And as we all know, generally higher gross margins tend to drive higher valuations in the market, and we are not seeing SaaS, cloud, 5G movement slow down anytime soon. And so because of that, I think this GDP metric is going to become a little bit more and less reliable over the next couple of years and decades, consistently with how Warren Buffett has been investing. But anyways, guys, make sure to drop me a thumbs up if you found some value in this video. Let me know down in the comment section below what you guys thought of Warren Buffett's indicator and whether or not this is a serious indicator we should keep in mind for when we are investing in our portfolio, and what stocks you guys are buying on the dip, and whether or not you just want to hold cash. But anyways, guys, I hope you enjoyed this video, and I'll catch you guys in the next one. Take care.